US inflation slows. Will it speed rate cuts at the Fed? Welcome to Market Insight. I'm David Pollard. Inflation appears back on a downward trend. US consumer prices rose only moderately in July, and the annual increase in inflation slowed to below 3% for the first time since early 2021. Good news for investors, for consumers, and for Fed policymakers who now have more scope, perhaps, to cut rates next month. This in a data-heavy week where, after a softer than expected PPI reading yesterday, we also get retail sales and consumer confidence numbers over the next 2 days. Well, let's get a view from First American Chief Economist Mark Fleming. Welcome, Mark. Many thanks for joining us today. From 9.1% this time just over 2 years ago to 2.9% last month, headline inflation is now vanquished, isn't it?
Or really close to being vanquished. The only real thing that's preventing it from getting even closer to 2 faster is shelter inflation, which we know is a lagging indicator. And so I think today's report was good news that strengthens the argument for the Fed beginning to loosen monetary policy in September.
So is shelter still a concern? It was up 0.4% in these latest numbers. And if so, how much? And what are the other surprises today, both good and bad?
I guess it's a concern more broadly. Shelter inflation in the long run is going to be a concern because we just haven't built enough housing in this country. So there's a sort of a pressure there in the long run inflationarily. But movements month to month, we know that it lags by 12 months. I think all is good. And it implies that most every other component of inflation is barely inflationary at all. And that's particularly good for the consumer when they go to the grocery store out to eat.
So do we have enough of a downward trend in inflation to reassure some of the more hawkish policymakers at the Fed, like Raphael Bostic, who said yesterday he needs more data before committing to the idea of easing rates? And indeed, is the Fed rather slow to come round to this point of view that it must actually cut rates?
I mean, compared to other countries, yes, the Fed is slow. Other countries have already started the monetary loosening cycle. I think it all has to do with the dual mandate. When the labor markets were so strong and the economy seemed so strong, why not keep the foot on getting inflation down? There was no real cost to doing that from the Fed's perspective. Now that there are some indicators that the economy is weakening, the labor market is weakening, unemployment is rising, you have to sort of look at both sides of the coin and say, well, if we've got some good numbers here, there's data, they like to be data-driven, there's data that suggests the mandate on full employment is beginning to be at risk, so let's take a move now.
Well, the next big data point this week is retail sales tomorrow. We also have the University of Michigan Consumer Sentiment Index on Friday. And yesterday we had some pretty downbeat Home Depot earnings. Is the consumer exhausted after such a long period of high rates and high inflation?
I mean, the consumer is clearly pessimistic, even if the economy is doing well and the unemployment rate, while rising, is still very low. The consumer is pessimistic, and that's because I think we see the price of eggs and the price of milk, and we remember what it was 2 years ago when we go to the grocery store, and that really influences our expectations about the economy.
Now, you're a housing specialist as well, of course. This week we have building permits, housing starts, and the NAHB Housing Index, which slipped to its lowest level in May and has gone on falling since, though mortgage rates have been looking a lot easier just recently.
That's right. The markets are front-running the expectation of Fed rate cuts, and that's being built into the 10-year Treasury, which in the last couple of weeks has come down dramatically. And that's been already seen in mortgage rates. Mortgage rates are closer to 6.5 than over 7. Where they were at the beginning of the year. We see refinance activity picking up. So it all comes down to, if monetary policy loosens and mortgage rates come down, then the housing market will begin to rebound and confidence in it will increase.
So would you argue that there is a more benign outlook across the whole of the US economy now? And if so, what are the flies in that ointment? Where are the risks? And is one of them a possible recession? How big is that risk?
If you believe in correlation relationships like the SOM rule, that suggests that we're already in recession because of the increase in the unemployment rate. Recessions are never good. that certainly dents consumer confidence when it comes to the housing market. People tend not to make big ticket purchases like a house when we're in recession. So yes, that risk is there, but by the same token, we still could have that soft landing if the Fed sort of threads this dual mandate needle effectively. And lower rates and lower inflation mean less expensive credit and and prices not continuing to rise, importantly not declining, but not continuing to rise at the grocery store. And that's all good for the consumer, and I think they'll feel better when they start to see that sort of thing.
Okay, Mark Fleming of First American, many thanks for sharing your thoughts with us today. That is Market Insights. You can watch more videos on Reuters.com.